What is a tax reconciliation? An accounting profit to tax reconciliation is the act of reconciling the net profit from the financial accounts to the income reported on the tax return. We will add and subtract the non-taxable items. Now we have an example of this in a minute. So why do we perform a tax reconciliation? The taxpayer does not pay tax on the net profit which is residing in the financial statements. The taxpayer will pay tax on taxable income. So in many cases there will be a difference between the net profit of the accounts and taxable income. Sometimes it's possible for the accountant to miss a tax reconciliation item. So it's a good manual check to verify the tax return. That's one reason to complete a manual tax reconciliation. Secondly, IAS 12 requires many disclosures in the financial statements, including a tax reconciliation. Now let's have a look at a basic tax reconciliation example. We have Newmark Proprietary Limited, an Australian company that has the following items for the year ended 30 June 2020. We have net profit before income tax of $100,000. Speeding fines, non-deductible for tax purposes, $2,000. An accounting provision for bad debts, $3,200. Actual bad debts written off, $890. Depreciation for accounting, $3,400. And depreciation for tax, $22,000. So we need to have an understanding of non-deductible expenses. These are outgoings incurred, but the taxpayer can't claim a tax deduction. The accountant will add these back for the purposes of the tax calculation. Now, the items that are added back here depend on the legislation of your country. But for Australian tax purposes, examples include fines, entertainment, bribes, goodwill impairment, and more. Another possible category is tax-exempt income. The accountant will reduce or subtract these items for the purposes of the tax calculation. An example of this is the cash flow boost income. So let's head over to Excel and see what this looks like. So you can see we're in Excel. We have the company Newmark Proprietary Limited, and we're performing the income tax reconciliation for the year ended 30 June 2020. Now we've started out with our net profit before income tax, and that comes from the financial statements. This is effectively the accounting profit of $100,000 in our example. Now our speeding fines are not deductible. We're going to add those back. That's $2,000. The speeding fine of $2,000 has been added to the net profit of $100,000. That means that so far our taxable income is $102,000, but we still have more transactions to add. We will now add back the bad debts for accounting purposes. That's the provision for bad debts. We will take off the bad debts that have been written off during the year. They're tax deductible. Now we have another video that explains bad debts on our website. So let's enter the $890 of bad debts written off. So with the provision, like bad debts, we add back the accounting provision, then we take off the amount that is allowed as a tax deduction. We're going to do the same for depreciation. So we add back the accounting depreciation of $3,400, and we take off the depreciation for tax of $22,000. Scrolling down, that means that our taxable income is $131,490, $131,490. after adding back our non-deductible expenses effectively and taking off the amounts allowed for tax. In the 2020 year, the tax rate is 27.5%. So the tax on taxable income is 36,159.75. We've had PAYG Instalments paid for the year, $20,375. We have a link in the description below that explains a PAYG installment. Finally, the income tax payable is $15,784.75. And if we scroll down a little further, we have provided you with the journal entry.